Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Welcome, everybody, to the Fintech Blueprint and today's conversation. I am really excited to have with us Bill Capuzzi, who is the CEO of Apex. Apex is one of the most impressive fintech companies that I've seen in terms of its growth and position in the industry. And I'm really excited to learn about its evolution and the journey that Bill has taken it on. We'll talk about custody, we'll talk about embedded finance, and we'll talk about the growth of the industry overall. So with that, Bill, welcome to the podcast.
Thanks so much for having me. I am blushing at that intro. Thank you very much. It's a pleasure to be on with you.
It's fantastic to have you on. I want to go directly to Apex and talk about it, but we have to be fair and try to start at the beginning, which is to understand you as a person a little bit and understand kind of your journey into building your own company, being able to play in this space and so on. Can you talk a little bit about the early foundational experiences that you had that kind of converged you to where you are today?
I will tell you, you look back on my 22-year-old, if I was to tell you or tell myself that in 2023 I would be where I am, I would have thought, that version of me was crazy. So I finished college. I went to school in Connecticut, Wesleyan University, and I had every intention of being a doctor. And I love science. I love understanding how things worked. And I also had a desire to make a difference in the world and connect those two dots. Is like, okay, well, the obvious thing was, hey, let's go to med school. I came out of Wesleyan with an environmental science degree and a mountain of debt, to be frank, coming out of college. And, the thought of going to med school just in terms of, taking on more debt was daunting. And so I thought, hey, let's get to work. Let's make some money. Let's put some money in the bank. Let's pay down some of this debt, and then we'll get to med school down the road. And so I started my working career as an environmental scientist. All right, I had this degree, and I went to work for an environmental science firm. I quickly learned that was not my calling in life. While I loved the science part of it, there were parts of it, aspects of environmental engineering and science that just wasn't going to be kind of my long-term plan. And I still wasn't ready for med school, because it's a long journey. And so I, again, mountain of debt, I went and worked at Rutgers University. And the reason I went to work there was because I could get my MBA for free. And so I went to school at night. It was my first time managing people. I had a team of 12 union women, and I managed the alumni records of Rutgers University. What an experience, let me tell you. First was just managing people. Two was kind of digging in. And it was there, the one thing I took from that, which was, kind of fast forward to today, was the process of managing all of these alumni records was so archaic and incredibly manual. I had these, all these folks that just rekeyed stuff. And, the sort of my fingerprints are all over that place even today. I still have friends that are there, largely around re-engineering. How can we make this thing more straight through? How can we put that sort of the updating of alumni records and people making donations, put it into the hands of the actual alumni? What a novel thought. So anyway, I finished my MBA. I went to work at DLJ, which was an investment bank in New York City. And it was my first introduction to finance. I really didn't know if that's what I wanted to do. I still had designs on going to med school, but again, had a desire to put some money in the bank. And fast forward, DLJ owned Pershing. And so I went through their MBA program, and we went to different spots throughout DLJ, the banking division, the trading division, distressed debt, the capital markets groups. And I got placed, and I remember thinking of it as banished, the word banished. I did not get placed in the cool investment banking or the trading business. I got banished to Jersey City, working in this company called Pershing, who I'd never heard of before. For those that are listening, Pershing is one of the original custody clearing firms in our industry. Not too many people know the name, but it's an amazing firm that helped kind of craft a lot of what's in the industry today.
BNY Mellon today owns Pershing, is that right?
That's right.
How strange is it that kids coming out of school now are like, I want to be in this fintech company that does, settlement on chain. Like, I'm so excited about transactions you don't have to reconcile. It's decentralized transparency, and just the contrast to the black hole of finance and investment banking and like capital markets, like that contrast between how cool fintech is now versus how cool like that sales culture was. I mean, it's just so stark to me.
Totally agree with you. I think it's nice for me to see now, sitting in my seat, that there's a focus on the sort of plumbing, the back office, the sort of bowels of our industry, because we'll get into it, but it's how this industry goes or not. Think about all of what's happened over the course of in my career, 25 years. Most of the focus for the last 20 of those 25 years is really cool front office tools. And think of it as sort of an inchworm, right? So the front of the inchworm moved forward over 20 years and put a lot of focus on really cool front ends and the trading technology and the sort of how you invest in things and market data, but not a lot of focus on the back end. And again, use the analogy of the inchworm. Without that back end, sort of frankly pushing the front end, there's lots of inefficiency that comes with that. So it is fun to watch this sort of next generation leaning into the back end of the inchworm.
It's possible that there's going to be nothing but the back end soon enough, but we'll see how that goes. So you're at Pershing. You've been banished. What's going on next?
Well, look, I think this is the first time when I said, hey, maybe med school isn't the path for me. And the reason for it was, again, I'm a young man. I'm in my 20s, and I look at Pershing and look at what it does and look at who it supports and the ability to make a difference. It's an amazing opportunity to make a difference. And so I spent roughly almost 10 years at Pershing and really learned the bowels of our industry. I think for folks that are listening to this, it's funny having young folks come into Apex today. And one of the things that I say all the time is don't skip steps. And what I mean by that is, take the opportunity to learn at a really detailed level, because it matters to understand the details. And young folks typically today want to sort of get ahead and sort of, get into some sort of top position and miss the opportunity to sort of really dig in and learn. And I will tell you that, and I'm really sort of fortunate and thankful to the folks at Pershing back, this is late 90s, is really giving me the opportunity to learn. And frankly, we're in a different business than Pershing-ish today, but really learn kind of what's wrong with that inchworm. I'll use that analogy again, which is the back end of things are manual, they're batch-based, they're paper-laden, and as a result, you can do an amazing thing with the front end, but at the end of the day, that custodian really calls the shots on how things are going to work. And so I left Pershing about the 2005. I helped found a company here in New York City called Convergex, and the premise of Convergex was, how do you create? It was a technology company, and it was focused on sort of the big investment managers, hedge funds, and it was around how do we kind of disrupt the world of trading technology and software, and connect the dots between this platform called Castle Software, which was a sort of premier platform used by most of the hedge funds, and trading technology, whether it's algorithms that were built, and make that connection really tightly coupled. And so I spent, again, almost 10 years at Convergex. And my connection into Apex was I tried to buy it from the parent company, Peak Six. For those that don't know the story of Apex, Apex sort of rose from the sort of ashes of a failed company called Pershing, which was a public company, public custodian clearing firm. And they ran into massive issues. They really mismanaged custody and clearing and the collateral and the treasury functions. And as a result, went into bankruptcy. And Peak Six at the time had a company that used Pershing. They had founded a company called Options House. It was a client of Pershing. And when Pershing ran into major issues, really reluctantly, with a somewhat of a gun to their heads, the founders of Peak Six stepped in, met Holsizer, Jenny Just, stepped in and bought the assets of Pershing and created Apex. So now you have these folks in Chicago that now are the proud owners of a custody clearing firm, but didn't really know what to do with it. It saved their asset called Options House, but it was this custody firm that had some good tech chops. But the question is, what do you do with it? And so they looked to sell it. And I stepped in while I was still at Convergex to buy, because I knew what it was, right? I think, go back to my days at Pershing. And while I was at Convergex, I knew the opportunity, because there's not many of us. When you think about who's out there that can actually custody, we'll get into the tech side of things, but who can actually properly custody and clear a trade on a retail side? There's Schwab, there's Fidelity, there's Pershing. And then the list, now that TD's got sort of gobbled up by Schwab, the list sort of falls off from there. And so I stepped in, tried to acquire Apex from Peak Six, was obviously unsuccessful in acquiring it, but they convinced me alternatively to come across and run the firm. And, we're talking early 2015. And so the firm was, there was about 1 million clients on our books. It was a handful of clients that used Apex at the time. It was sort of a very circuitous route to get to where I am today.
Yeah, you were reverse acquired by your target. I want to just lay down some of the foundations for folks who are not as deeply familiar with the industry and define the word custody and probably the words clearing and settlement. I've traveled a little bit out of the investment management RIA world or the broker-dealer world, and these words start taking on lots of other meanings to people as well in capital markets. And then there's the European structure, which is different too. And the overlay on top of all of it now is that the word custodial, I think for younger generations, is almost tainted as like this custodial centralized experience where my assets are at risk because I don't hold them myself. So maybe just going back to how you saw things joining Pershing or how you see the industry now, like what is custody, what is clearing, and what is settlement?
Yeah. And by the way, I think that you're right. Those words mean different things to different people. And I think, we'll go back to the Pershing days. At the core, the custodian holds the assets of the end investor. Now, there may be an intermediary, so let's use, an Apex today, which, we support somebody like a SoFi as an example. SoFi is a sort of the client-facing entity, but at the core, at the end of the day, there is an entity, in this case Apex, and back in the day it was Pershing, that actually holds the assets of the end customer and safeguards them. And I think it's good for you to sort of double click down on that, because at the end of the day, that is the most important thing that we can and should be doing as a firm, is to protect the assets of the end investor. And the whole reason I'm sitting here today is because Pershing didn't do a good job of protecting the assets of the end investor. I think the second thing I would say is, you mentioned capital markets. I'm focused solely on sort of the retail side of things. There's the institutional side. We start thinking about custody. for the BlackRocks and the Invescos, the big sort of asset managers that are out there. Then we're talking about State Street. We're talking about the Bank of New York. We're talking about Northern Trust. That is a very different sort of notion of custody, because there is no end customer. Ultimately, there is, but in the case of custody for institutional players, it really is more about sort of holding those assets for those big fund complexes, and much less about sort of how do you open an account for an end client? How do you take money from that person's bank account, let's say it's Citibank, and move it into a brokerage account? The retail side is much more complex, just in terms of the ergonomics of making a great experience for an end investor. The second thing you asked about was clearing, and they sort of go hand in glove. So I hold the assets, I'm holding cash, I'm holding securities, maybe I'm actually holding cryptocurrency today. The clearing side of it is when you do a transaction. So Lex now has $100 in his account, and you want to buy Tesla. You want to buy a fractional share order. You want to buy $100 worth of Tesla today. I'm holding the $100. You now put in a trade. You do that trade with clearing. So the definition behind the clearing part of it is there's, in the bowels of our industry, there is a buyer, a seller, and there's something called DTCC in the case of an equity that sits in between. And the buyer and seller interact with that DTCC industry utility to make the buy and sell happen between the two counterparties, what they're called. That's clearing a trade. And so, the Apexes of the world, the Pershings, the Schwabs of the world provide those functions. We custody those assets, and then we provide the clearing of those transactions between, again, in the case of a buyer or sell, through that entity called DTCC. In the options world, it's called OCC. In the crypto world, which maybe we're going to go down a rabbit hole on this is part of that DeFi, decentralized sort of notion of blockchain, which there is no central counterparty. And, frankly, over the last, 12 months, we've seen some of the challenges by not having more of central counterparties and transparency into how things work. A little bit of back to the future around crypto, specifically around clearing of crypto trades.
Yeah, and I think that does open up an interesting door, and I'm happy to take a look behind it, which is the industry segmentation in traditional capital markets, and investment management as adjacent to that is kind of, because the industry is so big, like you've got these really thin horizontal slices. An exchange is different from a custodian, which is different from a broker dealer, which is different from a financial advisor or, some other distributor and so on. And so it's not surprising to somebody that they think they're using Betterment, but actually that's not where their money is. Or they think that they're using quote unquote SoFi, right? But it's custodied on Apex. And in the banking world, that's not the case. Like your deposits are your depository institution, but in the investment world, you do have the separation of the custodial function. And in crypto, what we saw was the failure in exchanges that intermediate access to the blockchain. So, if you're holding something yourself through your own wallet on chain, then you're not losing it in FTX. But for a centralized exchange like FTX, the custody function and the broker-dealer function, and supposedly, the whatever you would even equate to an advisor in there, all of those are vertically integrated, and there's conflicts all the way through. So how do you think about this industry structure? Like, why is custody unbundled? Does it make sense that it's separate from the broker-dealer side or the retail distribution side? Any thoughts around sort of like the regulatory reasons for that, the conflicts around it, all of those issues?
So, of course, I am somewhat biased in my answer, but I think, given my position, but I will tell you, really trying to be unbiased in the answer. Let's just start by saying, let's start on the sort of nefarious side, which is, okay, how do you mitigate any potential issues, for end investors? And the cool part about, again, we'll use Stash or SoFi, as examples, or Goldman Sachs Marcus, who uses Apex. There's a separation of church and state. And that's really in the best interest of the end investor, meaning that you have, again, we'll use SoFi, you have an introducing firm that sort of supports the end customer in terms of the customer service and the sort of app support and the sort of client-facing side of things. But there's a separate firm that is really well capitalized, in the case of Apex or Schwab or Fidelity, that actually holds the assets. And so there's a separation of church and state, so to speak, that really is in the best interest of the end investor. Because, I think, we're seeing sort of the back end of the pandemic bubble as it relates to investing. And there's a lot of introducing firms that aren't going to make it, meaning they're going to run out of money, right? And so somebody opened an account with insert here, that firm decides that they're out of business. Your assets are still protected at an Apex. Your account is here, and I know who you are as an individual, and we're going to make sure that you get taken care of in the event that introducing firm that originally got to you and you decided to open an account with, that firm goes out of business. So that's the sort of, I think the positive to the potentially negative of what's happening in our industry today. I think the more synergistic reason for that separation is it's a perfect symbiotic relationship. And what I mean by that is, and we'll see, we're going to talk about blockchain and what's going to happen with blockchain. But when I say symbiotic, it's say, let's pick on Stash. So Brandon Craig runs Stash. His focus is on creating this amazing end client experience through a handheld app. And how do I connect the dots between banking and investing and lending, and providing an amazing end client experience? My job is to bring those things to life behind the scenes, right? And so there's a separation, there's a divide and conquer, however you want to put it, where our interests are perfectly aligned, right? So Brandon, let's use him as an example, calls me and pushes me on how do we automate an ACAT? And again, I'm throwing terms out there, but how do you automate? ACAT is the term, the acronym used to describe a transfer from one account, let's say from Robinhood to Stash. And I do the plumbing. Apex does the plumbing, the hard work in the guts of our industry. And Brandon does the hard work in terms of the client experience directly to that end customer. And so that union, if done well, and I think, I would say, back to the bias part, I would say Apex has done an exceptional job of that. The union of sort of that front office versus middle and back office, and having firms focus on what they're great at and then deliver solutions that are sort of tied together. That's the sort of holy grail. And, look, I think if you got some of those folks, I'm sure you've had them on your podcasts, they'd be the first ones to tell you that they're not good at what we do, and I'm not good at what they do. And we saw it play out. Robinhood launched on Apex, was a client and a partner of Apex for a really long time, and then got a lot of pressure from their shareholders to try and do what Apex does. And so a number of years ago, back in 2018 into 2019, they decided to do their own what's called self-clearing and custody. And time has passed now, but we saw through the pandemic in 2020 and then infamously in 2021 why that was a really tough decision for them, because getting the custody and clearing right, they had their major issues with having to raise $6 billion in a weekend. That was a direct sort of outcome of sort of stepping into a really complicated part of our business, which is this custody and clearing.
Yep, absolutely. There's two things I wanted to pull out based on what you said. And the first one, and I'm still kind of stuck on it because I think it explains a lot, is this like necessary segmentation between where all the assets sit, which is really in 3 or 4 firms. So the pie is that scale and is divided to large firms. So naturally it forms that distribution. You can't have lots of little custodians. It doesn't make sense. Why is that not the case in the banking case? And I think in the banking case, you do have protection for firms that are small that blow up, and that protection is the FDIC.
Right.
And so you have a different solution there to the threat of your bank going under versus the investment industry, where it's instead sort of become industry structure and itself through the separation of custody and distribution instead of through like a giant insurance pool backed by the government. And so that's kind of interesting. The other interesting bit is that the fees that you get out of custody are very thin. So that also drives the industry structure to create only a couple of players, because you have to get them to be as big as possible in order to build a profitable, meaningful business, which you have and which the other players have. And that in turn also creates like value splits with your distribution partners, because you want your distribution partners to make a lot of money and be sustainable and grow and bring back those accounts. Which leads me to the question, and I'm curious to your thoughts on it, around the temptations that a custodian might have, like a Fidelity or Schwab, to go up market into the business models of the people that they support. I remember very clearly so much, because at Advisor Engine, we had worked with TD and they were very friendly in terms of separating out, this is the custodian bit, and then this is the fintech bit, and this is our clients, and this is how we create the ecosystem. And then, of course, worked with you as well. But then other custodians like Schwab or Fidelity were often criticized for competing with the very advisors that they were trying to custody for. So, famously, both of them, I think, now have a digital wealth management platform competing with either robo-advisors or traditional advisors using robo-platforms that plug into their custody. Can you talk about that dynamic, like that tension of figuring out how far up you go in the stack and where is the right line to draw?
So I think I'd say a couple things. One is it's interesting today about convergence that's happening in our industry. And we'll talk about sort of just the fintech. There's kind of 2 dimensions of convergence. One, within fintech, the convergence between banking, investing, lending, right? We're seeing sort of this advent of super app. So you have that on one side, and then you have sort of traditional advisory, which, by the way, is where most of the assets live today. I don't know about you, but through the pandemic, I sat at home and I had CNBC on every day, and I would watch these commercials for Schwab Intelligent Portfolios, which is sort of their robo product for the end customer. And the commercial depicted this sort of doofy advisor interviewing a married couple and asking questions around how they manage their money. And the couple would respond by saying, here's all the cool things this Intelligent Portfolios does. And the advisor would be like, damn, that's Schwab. And I found that commercial striking because Schwab today sort of plays both sides, right? So they have a direct-to-consumer product that's getting even bigger through the acquisition of TD, but they also support B2B, all these advisors that are sitting on their platform, leveraging them as a sort of custodian, where we started the conversation. And so there's just conflict there, right? And part of the reason the industry, at least the advisory industry, has tolerated it is because there really haven't been any good alternatives. So if you're an advisor and you're managing $1 billion, where are you going to go? Right? So and you're sitting in the US, you have Schwab, you have Fidelity, you have Pershing, which is purely B2B. But really the 2 big players was Schwab and Fidelity. And that's 6 of one, half dozen of the other, because in both cases, they employ both sides, right? They're the B2B custodian for the advisor, and they have very robust direct-to-consumer solutions, which inherently creates conflict. And again, this is where one of the ways that Apex is differentiated. We have 0 designs on ever being in the B2C business. And I'll go back to the reason that I said before, which is I'm great at plumbing. We're great at bringing to life via real-time APIs, real-time data, bringing to life a transaction, right? Some sort of interaction with that client. The engagement with the Lexes of the world, the end customers, we're not good at. We don't want to be good at that. And so, we've found ourselves in a position where we can use technology as a sort of great equalizer against, some of the bigger firms out there. And the second way is to say, hey, look, we'll never compete with you for your clients. Our job is to support you behind the scenes, right? And to the extent possible, keep our name way out of the sort of limelight and, sort of shine the spotlight on the SoFis and the Stashes, the Goldman Sachses, because you're out there in the front sort of managing and supporting the end client.
Totally. That makes sense. It is a great point that there's not a lot of choice. Going back to the story of you joining Apex in 2015 and seeing an opening, seeing an opportunity, let's talk about that. What were some of the early customers? Like, who were your best customers around that time, the mid 2010s? What was the tech stack like, and where were the room for improvement, and kind of how did you see that in that earlier moment, like where you were and where you were going to go?
So I'll start with, I understood, and I love this concept of straight through processing. It's an old term, but the concept of how do you take friction out of a process, right? It's sort of the way my mind works. And in the investing world, my goodness, was so much opportunity. Let's rewind to 2014, 2015. It's like, boy, oh boy, it's such an opportunity for us to eliminate friction. And, the sad truth is that when you're dealing with an account, $100 million high net worth client, having them sign paperwork or, doing a transaction and taking 3 days, no one really cared because there was some concierge, there was some advisor that was just going to make it look great. When we're talking about the fintech world, there is no concierge, right? You can't fake real time. You can't fake an unpleasant experience when the end customer is sitting on their phone and they're trying to do something. I think this world of Amazon and some of the other experiences for sort of the consumer, why is investing so much worse? It doesn't have to be. All right. So I go back to the early days of Apex. It was neat because you go back to the symbiotic relationship. We acquired the company, the assets of Penson, and with it came a whole bunch of clients that were sort of the OGs, the godfathers, the godmothers of the sort of modern fintech. So you go back to the motifs of the world, the Betterments, the Wealth Fronts, which was called, I think, Kaching at the time.
Yeah, I was going to say, may they rest in peace as you as you take out the names and shake the carpet and the dust comes out, right?
Yeah, but what they were doing back then was saying, hey, there's a better way. And what we need is a partner. We'll take care of the sort of client experience side. What we need is a partner that's going to allow for zero commission. I mean, it's now everybody's zero commission, but you're talking 2015, 16, it's like offering zero was unheard of.
How did you do it? What did you do to get there?
It's hyper efficiency. Like, so again, I don't disparage too much, but we have today, and we're talking now 2023, we have 850 people at Apex. We support almost 24 million end investors. How do you do that? We opened 1 million accounts in a weekend last year, through this sort of pandemic. How do you do that with hundreds of people, not thousands of people, right? So you think about some of those big custodians that are out there, traditional players, you're talking thousands of people. And so how do you offer zero commission? How do you do fractional shares? It's hyper efficiency. It's maniacal focus on eliminating waste. And the waste in our industry is time, it's paper, it's manual intervention to things that are unnecessary, right? So why does it take 3 days and DocuSign and manual approvals of an account, right? If Lex comes on, and you put in your social security number and your address, and we can interrogate that information and in a real-time way say Lex is who he says he is, and he's not a bad actor as it relates to any of the regulatory bodies. Open the account, pass back an account number, real time. It sounds so obvious, but for our industry, which, go back to the inchworm analogy, really that back end, because it's sort of focused on some of these big, larger, kind of slower moving players, didn't move forward, which opened the door for two things. One is Apex, obviously, fast forward to today, but it also, which I'm proud of, it spawned all of these amazing companies that are helping all of these people, right? And I'll include the Robin Hoods of the world, right? Despite some of the challenges they've had recently, in sort of helping the quote unquote undesirables in terms of the end investor, people that don't have a lot of money, but yet still want to invest in their future. And so you go back to those early days, and so in the DNA and sort of the culture of Apex is much more of a tech company than a traditional Wall Street custodian.
I know we're going to come up on time soon, but I wanted to ask about what you can learn from the clients that you're seeing grow the most on your platform, and not in particular to name, this firm or that firm, but what are the types of things that 22, 23 in these turbulent years, what are the types of companies that are growing for people who are far away enough from this industry? And like you read the World Wealth Report or something, and it's like, well, UBS added another this many billions, wealth management's doing great. I'm sure that if you look at the trends in the tech-enabled financial companies that you're supporting, you can see the direction in which the wind is blowing in terms of who's actually winning in B2C.
Yeah, for sure. And I think there's a couple of things I'd point to just in terms of the things that they're doing. One is, talked about sort of convergence. The first thing is they're continuing to sort of broaden from being sort of, where they started as a sort of one-dimensional company to being much more of a sort of holistic platform to help people invest. And so what I mean by that is if you started as a firm that allows people to point and click and buy individual stocks, adding, sort of a passive investment option to the platform is just smart, right? Especially today, which is, people that thought they were incredibly smart, savvy investors picking stock, the last 2 years are finding that it's a lot harder than they thought. And being able to provide an alternative to allow them to sort of park more passive money and sort of expand into sort of, be able to pick stocks, but also do the sort of passive side. Those people are winning because those assets that were so easy to make money on in terms of buying stock or cryptocurrency, a lot of those assets are moving over into more passive investments. The second, I would say, is, getting out of just investing, connecting the dots between, let's focus on banking and investing. A number of our clients that have had success and have scale have added banking services. And it's smart because they have a captive audience. They now have millions of customers, and connecting the dots between, sort of that investing vertical and a banking vertical just makes a ton of sense. And oh, by the way, back to your point before about the verticals in banking, the experience that end customer has at any of the big banks, and I won't name names, it's not a great experience. And the advent of the neobanks has allowed for folks that use Apex to pretty simply be able to offer a banking product that's much more on brand for this sort of more millennial, Gen Z, sort of more tech savvy, client base. And then the last thing I would say is, and this is more very specific to right now, but then you talk about asset classes, fixed income has, and alternates, alternate investments have become a lot more desired. And so the winners for Apex are those that have been not only been able to scale or move laterally in terms of the sort of product breadth, but then the asset class coverage, and in particular around fixed income and alts, has been something. And again, this comes back to the partnership with Apex. Those are the things we do behind the scenes for them, right? And so instead of them having to go out as a self-clearing custodian and have to add fixed income, they just say, turn it on for us, Apex. Come back to the sort of symbiotic relationship. It just works, right? It allows them to offer those things and deepen the relationship that they have with the existing customers that they brought on over the last 2-3 years.
That's fantastic, and a great place for us to put an exclamation mark. There's definitely more we can talk about, and hopefully we'll do that next time. Bill, if our listeners want to learn more about you or about Apex, where should they go?
ApexFintechSolutions.com is our website. Best place for folks, I guess, to reach out to me is on LinkedIn. It's William Capuzzi, Capuzzi. I do, keep on LinkedIn. So if folks want to connect with me there, it would be great.
Awesome. Thank you so much for joining me today.
All right, Lex. Good to connect. Happy New Year, everyone.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.